Okay, so I think it's a pretty important topic to look at the way that money grows. And so we're going to be looking at this exponential growth model in the case of savings. Okay, so let's imagine that we are 22 years old. We have a job and we have scrimped and saved and we have $10,000 and we want to put the savings somewhere. So we can put it in a bank or we can put it in the stock market. And of great interest to us is how well our money does over time. So we're going to say we're putting this somewhere and we're going to come back in 50 years and see how it went. So, all right, this is the exponential model we're using, where S naught is this initial investment, that's $10,000. R is going to be our percentage increase or decrease in our account per time step. And our time steps are almost always going to be just a year. T is going to be the amount of time that we wait, 50 years. And capital T is going to be our time step, which will be a year. Okay. All right. So the first place that we can put our money is in the PNC Bank growth account. So this has a yearly growth rate of 0.03%. Okay. So to figure out our money after T years, we're going to take the growth rate, 0.03%. We need to convert that into a decimal. This is going to give us our base, 1.0003. We take our principal, or that initial amount, times 1.0003 to the T. And so what I'd like you to do is make a first guess. How much money do you think we're going to have in our bank account 50 years after we have put our $10,000 in here? Okay, so come up with a guess. All right, and here is our plot. We have $10,000. This is our initial amount. We have the years on our x-axis. So it hasn't grown a lot. Okay. If we give this to our calculator, it will give us this rather disappointing number of $10,151. Okay. So at this growth rate, our function is increasing, but very, very slowly. We have made $151 in 50 years. Okay. So this label that is given by the bank, although it is true that this rate is higher than the other rates that the bank offers, no one would really call this like a really growing account. Okay. So there are other places we could put our money though. So there are like online banks that have high interest savings accounts. So for example, we might there are several online banks where you can get interest rates of about 3% per year. Okay, so let's take a look at how this affects things. So we started out with $10,000. Our base now is going to be 0.03. So we're expressing 3%. That's 3 over 100 in its decimal form and adding it to 1. And so this is our function. Okay, so what I'd like you to make a guess at is how much we have in our bank account in 50 years. So we started off with $10,000. We're not touching it, we're just letting it grow. Does that make a guess? Remember, at 0.03%, we made about $150. Okay. All right, well, here is the plot. We can see our starting value of $10,000 times 0. And we see that over time, this grows quite a lot. All right, if we calculate 10,000 times 1.03 to the 50, we get $43,800. Okay, so we have made $33,000, almost $34,000 over those 50 years. Our money has more than quadrupled. Okay, so that's pretty good. All right, so a little bit about the stock market. So an S&P 500 fund is what's called an index fund. It takes the top 500 largest stocks and weighs bigger companies more. And it's used commonly as a representation of our full stock market. All right, so here's a graph of share values between 1993 and 2022. Right, so we're not saying that we should go out and buy any particular stock, but the idea is that we buy a cross section of the entire market, and overall it trends up. Okay. So it goes up and down some, but overall it goes up. On average, the return on these investments is 10%. The best years and the worst years, the average return is going to be 10% per year. Okay. All right. So, so that means that when we build our growth model, we have 10,000 times 1.0.1 t, or 10,000 times 1.1 to the t. Okay. So we started with $10,000. And we'd like to know how much we have in 50 years when we were ready to retire. Okay, so what I'd like you to do is make a guess. We saw that when we had the high interest rate, that 3% allowed us to quadruple our money. So we went from $10,000 to about $43,000. Make a guess. All right, so this is a very nice looking graph. At the bottom here, we see our initial investment, and we see that it is growing very quickly. All right, if we calculate 10,000 times 1.1 to the 50th, this gives us $1,174,000. So we've made $1,164,000. Only our initial $10,000 is what we put in. Everything else is just built from this growth. Okay. So if we take a look at the graphs here, in blue, sort of not changing, is that 0.03%, right? In green, we see that 3% rate. And in red, we see the 10% growth rate. So the rate that we have is super duper important in terms of telling us how quickly our money will grow. Awesome. Okay, so we're going to look at a couple of examples where we have, so it's a common thing to, rather than calculating the interest that we make, the new money, once a year, it's common to calculate that interest in shorter time segments. And so that's what we're going to look at next, is if we compound our money more frequently.